So as we've been discussing, in a world with capital markets, the risk of bankruptcy is not a disadvantage of debt. Rather, it just shifts ownership from equity holders to debt holders. It doesn't change the value available to all investors. However, bankruptcy is never simple, and it is always complicated and expensive. So the bankruptcy code was created so that creditors could be treated fairly. So there's two types of bankruptcy in business. Chapter 7 is referred to as liquidation. Essentially, somebody is put in charge of the company, and that company liquidates. The proceeds then are used to pay creditors. Eventually, maybe the shareholders could get something if there was anything left over, but essentially the firm ceases to exist. Chapter 11 is more common. Essentially, what happens here is all the collection attempts are suspended, and the company creates a plan to continue operating the business, but the idea is to reorganize so that we can get ourselves out of this financial pickle, if you will. So this is going to specify the treatment for each creditor of the firm. Now, of course, those creditors are going to have to agree to this, right? So they could receive cash payments, maybe new debt. It's almost always going to be less than what they would have expected to get otherwise. So again, obviously they have to vote to accept, but if it's not acceptable, the ultimate thing then is they would go to Chapter 7. So they could get something or they could get nothing. So the process, again, as we mentioned, is very complex. It's very costly. What we end up with here are some costs, right? We have direct costs and indirect costs. So time is involved. Obviously, it could take a lot of time to get through this bankruptcy process. So again, it is a complicated, time-consuming, and very expensive process. So the direct costs of bankruptcies could be, for a publicly traded company, 3 to 4% of the value of the assets. For Chapter 7 liquidations, right, of small businesses, it's closer to 12%. So again, 3 to 4% of pre-bankruptcy market value is pretty expensive for most larger corporations. So again, companies want to avoid these costs. One of the ways they can do this is something called a workout, right? So again, in this case, many of these direct costs are foregone, right? We don't have to worry about them because they're not incurred, right? So again, the direct costs of bankruptcy shouldn't exceed the cost of the workout, right? I mean, there should be a trade-off here. So this pre-package, right, pre-pack, it's just a method of avoiding a lot of the legal and direct costs. The company can emerge much quicker, from bankruptcy. And again, we can minimize the costs. Now, what about indirect costs? Indirect costs are very difficult to measure, right? But these are things, again, they're very intangible. You're going to lose some customers, suppliers, employees, right? And typically, when you lose employees, you don't lose the lower skilled kind of employees. You lose your best people because they're worried and they're going to go find other jobs. So again, there's lots of these indirect costs that are very difficult to measure. The indirect costs, it's estimated somewhere between 10 to 20%. So the direct costs are 3 to 4, 10 to 20. So we've got somewhere between 13 to 24% of the firm value can be lost because of financial distress. So again, there's a couple things we have to think about though, right? What's the losses to total firm value, right? So again, it's not just equity holders, right? Or debt holders or transfers between them, right? What are the actual losses that they incur? And next, the incremental losses that are associated with financial distress above and beyond them, right? We also have to try to identify them. So again, with these indirect costs, it's very difficult, right? We have to figure out maybe what these costs actually are. And it's very difficult. So this particular video is all about what are the costs of financial distress. And in the case of bankruptcy, right, again, we're talking about a total of 13 to 24% of firm value. Now, if you do a workout, right, we have this prepackaged thing, we might be able to eliminate some of the direct costs, but the question remains, will we still have some indirect costs? And I would imagine there would still be some indirect costs that the company has once it announces that it has financial distress, right? Once we figure out that it has a problem. So again, that's the end of this video. We look forward to continuing our discussion of financial distress and financial fundraising.